Good evening, everyone. Thank you all for joining us for this webinar. I'm Saket, Kumar, co-founder at ETF Junction. Let me share a brief on ETF Junction. I'm sure you have been hearing about it, seeing at YouTube and other places. ETF Junction is a fintech platform which intends to provide a complete ecosystem for the ETF industry involving manufacturer, all the stakeholder, which includes manufacturer, ETF service provider like stockbroker, investment advisor, influencers, and obviously above all the investors in India. The endeavor is to solve the underlying challenges which we have, which is the lack of awareness, education, proper infrastructure on ETF, and create a platform for smooth and proper infrastructure, inclusive growth of the ETF in the country. It's a pleasure to welcome all of you. This is going to be a very thought-provoking session, which would be covering passive and active investing, presented by ETF being called ETF Pathshaala. Would like to share that ETF Pathshaala is a forum for sharing valuable insights on ETF and passive investing from the industry experts. We have some of them today and eminent speakers from the field. This is being conducted on a regular basis, which is every month, and also feel free to keep joining. Thank you so much for the increase in the number of participants every I think from each session which we are having, and people have been just adding up to it. Coming to the today's topic of webinar, best of both worlds, right? So that's what we are achieving, portfolio objective with active and passive investing. We look forward to unravel the world of active versus passive investing. Is it or and? It's not about choosing one over other. It's about getting the best of both in any investment portfolio. So in this dynamic landscape of Indian investing, as we see, the active strategies have seen a burgeoning growth. If you look at last 23 years, 2000 roughly around a lakh plus AUM was there in the industry of and I'm talking about mutual fund, has just sprawled up to 47 lakh crore. That's the kind of growth which we have seen. But now we turn our attention to the new frontier called passive investing. Today, it's not about just understanding, but dispelling some myths about which is prevalent amongst a lot of our participants and viewers about passive and active, and also empowering you with the knowledge on both, right? So without any further ado, let me introduce you the eminent panelists which we have for today's webinar. I think first is Mr. Anil Ghelani. He heads passive investments and product at DSP Mutual Fund, as you can see on the screen. He's been a very strong pillar in the industry for so many years and served in different capacities. We are very fortunate to have him as a panelist here. I'm sure as we progress, we'll have a lot to hear from him. The second is Mr. Vivek Rege, founder and CEO, We Are Wealth Advisors Private Limited. Someone who has been spearheading the RIA movement despite so much of obstacles which RIA itself as an industry is seeing. A lot of onslaught from SEBI, but the way things are shaping up is really amazing, and I think Vivek has a very strong role there. Vivek keen, and all of us are keen to hear him. Third speaker we have is Koel Ghosh. He's from ETF Junction. He heads strategic initiative at our place called ETF Junction. So I'm sure the collective wisdom promises to enlighten us to the path of active and passive investing as we progress the entire session. Would request all the participants who are there to keep sharing any question which they have in mind. Whenever during the session, the same will be answered at the end of the session by our panelists. You can write the name from whom you want the answers to be given, right? So I think just to start the entire session, if you look at Koel, I'll just try to bring in here the question. I'll just come just to set the entire thing for this relevance of this. We have seen the active and passive, which is a part of the investing, and saving in Indian has been there for fairly long, which has really helped. 35% of the average saving which the Indians do, it's last 5-7 years we've seen a shift happening, and the physical saving, which was largely Indians' love for real estate and gold, is quite obvious. That has seen some changes thanks to the COVID, thanks to the effort by government in terms of all the infrastructure which has been created, or the payment gateway and XYZ. We have seen from 45% of the financial assets now moving to 55%, right? That's a commendable. What is more important to see that and just to give you what has really gained, clearly mutual funds, stocks, and what has lost is bank deposits. To give you some understanding how things have been, I think yesterday only the news came that the CDSL has now crossed 10 crore demat accounts, right? That's something very surprising, which used to be roughly around a crore and a half 4-5 years back. That is where it is now. That is touching roughly around 13 crore. So that is something which is immensely gained. We just spoke about mutual funds number. Bank deposit, if you talk about, some 10, 12 years back in 2011, when the bank fixed deposit used to be 50 lakh crore, mutual fund AUM was 5 lakh crore, roughly around 11%, 11.4% to be precise. Come, I think 12 years later, in 2023, September, the bank fixed bank deposits is roughly around 200 lakh crore. That's the number. It has gone up. And mutual fund is now 24.2%. Now, clearly, it is showing that, as big, the days are passing by, people are getting into the financial assets more and more, and, this will keep adding up. So, Koel, I'd just like to bring in here with there's so much of growth happening. Can you just briefly explain to our viewers, the key difference between active and passive investing, right? And also, what are the primary objective of each of these categories of investing? The second question also with this is that what are the main advantages of active passive investing, and do they play differently in a different market scenarios, right? Where one outperform others? Koel.
Yeah, thanks. Thanks, Saket. And I agree that the investment space is growing, and also the number of options that are there are growing. So sometimes for the common investor out there is a lot of confusion in terms of what they are getting into. Bank deposits have been the traditional way of going in, but definitely mutual funds are growing. So now let me, just to set the stage for, understanding what the best of both worlds, you need to understand what each world is. So active basically is nothing but where you have your fund managers are selecting the investments based on what their assessment is. So they have a research team, etc., who researches all the stocks or the portfolios, and then they will select the ones which they think will create the ideal portfolio and help them beat the market. Ideally, it is beating the market would be an underlying index like a Sensex or a Nifty if you're investing in something which is a large cap oriented index. But if you're a passive investor or passive investing, the goal is to basically match up the market index returns. So you are actually mimicking the index. So what happens in the passive investing is you are actually investing your funds in the same ratio as what is there in the index. So that's the thing. So which will give you ideally similar returns. A few advantages there is that there are lower costs because there's no expense of a fund manager using for the research, etc. So he doesn't need to, there are no additional costs. And in what happens in a lot of cases and has been displayed moreover both locally and globally is there are some cases where active fund managers do not manage to beat the index. Now that happens both ways in terms of depending on how the investment climate is. Now there are certain active strategies that tend to benefit investors even more depending on how the investment climate is, right? And there are some passive strategies that tend to outperform. So like say when the markets are volatile and the economy is weakening, active fund managers tend to perform more and generate what they call as alpha. But when markets are moving unanimously and equity valuations are more uniform, passive strategies tend to perform very well. So depending on what the opportunity is, that's where you need to kind of have a balance and have the best of both worlds. So it depends on the priority of the investor. So it depends on what life stage they are in. If he's looking to reduce fees and trading cost, passive looks good. If he's looking, a balance of return, risk, liquidity, he has to look at a mixed approach. So, this is where it all comes down to personal priorities. And of course, I always, keep insisting that do talk to your financial advisor. And today we do have financial advisor Vivek with us. So, I think we'll hear more from that in terms of, when you are planning on how you need to balance your portfolio and look at both worlds, financial, advisors play a very, very big role.
Thank you, Koel, for that clear understanding on both world of investing. What is passive, what is active? Thanks. Also, I think I'd like to bring Anil here, Anil Ghelani. As we look at, I think there was a report by CRISIL which talks about the growth in terms of Indian savings really galloping. As of now, we are roughly around, and this is slightly dated, which is March 22, 135 lakh crore is the total savings, and these are all managed assets. When we say managed assets, we are talking about mutual fund, insurance, PMS, alternate investments, and likes, right? So that's where. And if you look at just 5 year back, it was 63 lakh crore. And it is expected to be roughly around 4 to 5 year hence, 315 lakh crore. Now, this very important understanding to be seen. When this number is going to hit 3.15 trillion rupees, right? The GDP of the country is going to be 5 trillion. So roughly around 75% will be the total savings in the country, which as of now stands at 55%, which is, we are roughly on $3.5 trillion economy and 1.35, something around that. So that's where, if you look at that is kind of growth happening. All the viewer and the participants would like to understand, Anil, that in the context of the Indian investing landscape, can you share some insight into the historic performances, especially, between active and passive funds? And also, how can investor assess their risk tolerance and also investment goals to determine which strategy is it active or passive, which is more suitable to them and their portfolio? Anil.
Great point. I think I have a little bit different angle that today, as we look to increase the penetration, like you mentioned very rightly, the data points, broadly speaking, that as we touch $5 trillion economy, this kind of managed assets is expected to rise and become, let's say, 70, 80, 85% of the GDP. I feel it can even grow higher. Basically, if you look at global averages, it's close to around 100%, basically. Certain countries very much outlive more than 100%, but on an average. So, yes, definitely, in that kind of a huge penetration which is needed, passive funds, which are relatively easy to understand and relatively low cost, they can be the initial drivers, especially to get people started. Now, talking about what you mentioned, how can the returns profile, be compared of active versus passive? I think it's important to understand that we need to compare returns as well as risk profile, and I would say different category wise. So what I mean is that, let's say, if you look at the category of large cap investments or funds, like, because in your data, it is not just mutual funds, but it can be managed assets, like it can be through mutual funds, PMS, etc., everything. So if we look at broadly the pool of vehicles which can give us access to the large cap as universe, over there we need to be very cautious that rather than comparing which will give higher return, we need to be focusing on the consistency. Reason being, active managers are taking a judgmental call with the aim or intention to try and outperform the underlying index. Whenever you're doing that, it is like a coin toss. Heads aayega ya tails aayega. Means you either go outperform or you will go underperform. Now, in that race of trying to beat the outperformance every time, the divergence between the performance of the various fund managers has become very large. It is natural, basically, that you are trying to do something outlier. So some will do better, some will do not so good. So if I look at, let's say, not short term, 2, 3 years, 5 years, but let's say as an investor, let's say I have a long term horizon, 10 years, for example. And if I would have invested into, let's say, large cap equity mutual funds, I'm not talking about any one ABC fund house or XYZ, because it's not appropriate and legally we can't do that right now. I'm just talking about broadly as an average of all, let's say, large cap funds put together. And if we see data of the last 10 years, for example, the worst performing large cap fund has delivered returns close to about 12.5%. And the best performing large cap fund has delivered returns of close to about 15.57, 16%. So there is a huge gap between the two. And during that period, the Nifty 50 TRI, or the broad market index, has delivered approximately 15% return. So what I mean by that is that if you are guided by a well-informed advisor like Vivek is there, or some many other friends in the industry, and you would land up choosing the best fund, even then the divergence is very high. So if you are unlucky and you land up holding the fund which right now might be the best performer, has a fund manager who is following a very robust process, and hence the probability of delivering outperformance is very high, but still it is a judgmental aspect. Suppose at the end of the 10th year period, that fund lands up being this worst performer, then you will feel that, oh, I invested in a fund which has given me a gap of around 5 to 6% from the best performing large cap fund and about 3 to 4% from the broad Nifty 50 index as well. So to avoid that aspect, for certain this kind of component, it is better to go with simple, easy to understand, low cost passive fund. And for other aspects, one can go to active funds. So it is very difficult to say a specific answer ki how the historical performance of active funds has been versus passive. I would rather say that let us try to focus on the divergence between different active funds itself.
Correct.
That will be a very important eye opener, for us to get a sense that how important it is to consider some allocation to this kind of a portfolio, basically. I will later on, if it's feasible, I'll just share what nice chart on the screen. I can't share it right now, but in the chat window, I'll circulate that. Every quarter, we at DSP Mutual Fund release a quarterly passive deck, basically. And there we have done this nice analysis. I will just try to pull it out and share it in the chat window.
Thanks, Anil. I think that was really very good understanding of the way for the participants, also to understand that it's the collective wisdom, right, of the market, which is there in any passive funds, right? You're not taking a call on a particular maybe one person or maybe a team of one person like that. So that's clearly very, very important to see. And that's secondly, what Anil stated is that it's very simple and easy. So that is where I think if you look at the country just has 4.04 crore investors in mutual fund, 140 is still waiting to be coming in, and they are looking forward to the convenience and simplicity, and that is what it provides. Right. Coming to Vivek, Rege, is there any case, for example, if you look at Vivek, you are the one who is representing the investment advisory area, and investment decision rests on largely three legs, which is liquidity, safety, and return, right? And one has to make a good, calculated decision between the three to get something in your portfolio. Now, from your experience, is there any case for combining both active and passive in a portfolio? That's one. Second, how can investors strike a proper balance? What should it be the guiding force for that balance to have? And what are some practical examples or strategies for investor to achieve a hybrid approach that optimizes on both these strategies of active and passive? Vivek.
Yeah, thank you, Saket. I think that's an interesting question. So let me start with the first point, that is there a case, first of all, to kind of marry both together in one portfolio, okay, and blend it together. My answer to this question is emphatically yes. Why I say that is because when you look at a portfolio, okay, and as Koel also rightly mentioned, is that an investor has twofold objectives. One objective, when you are seeking a market exposure, you are asking for, and we have been asking for many years, and this has been a very, very popular way of that. Please beat the markets. Please beat the markets. I need an alpha. You beat the markets. Slowly, steadily, it so happened that it was not always possible to beat the markets, and therefore slowly investors started asking a question: please justify your fees. Are you beating the market after you have justified the fees? And sometimes the answer is yes, sometimes the answer is no. And then the world shifted towards saying that, okay, we don't see a kind of a evidence where the fees are also justified and they are not able to beat the market return after taking a fee into account. Then we should expect the market rate of return, right? So it started with beating a market rate of return. Then the world moved towards saying that, hey, look, I mean, there is some charge here. So after deducting a charge, am I still beating the market rate of return? Till an era where it was a yes, there was no problem. In an era where it started getting questioned, investors started asking the right question: is that, okay, if you cannot beat your fund performance after paying fees to you, then I will expect at least a market rate of return. And that is the birth of passive. So when you say that as an objective, I want to beat a market that is active, And when you come with an objective that, hey, don't beat the market, just give me a market rate of return, that is passive. Yeah. Why both are important? Because as we are moving towards an era where the information asymmetry is being lower over a period of time, okay, your returns are essentially a function of information asymmetry. Somebody is going to make more money because somebody has more information. Now, when you look at that particular framework, over a period of time, the information is being in the hands of everyone, right? And therefore, the information asymmetry is lower and lower. And when the information asymmetry is lower, and I'm not saying zero, it is going from let's say a 10 points to a 5 point to a 4 point and 3 points. Then therefore, what happens is that suddenly the role of passives become important. Because of the information asymmetry becoming lower, passives will definitely give you a market rate of return. Sometimes active may not. Okay. As Anil also mentioned, is that there is a wide divergence between the two. And why is it? Because exactly the same. Because this information asymmetry is going down, and sometimes the fund manager is able to beat, sometimes no. So I think that is why the point I'm trying to make is that always have a blend rather than going one way or the other way. That is point number one. Coming to a very practical case, and let me give you two examples because I think the audience will be able to appreciate that better when an example is given. Look at a life stage who is a pre-retiree. Essentially, a pre-retiree is somebody who is away from retirement, maybe about 10 years away from the retirement. Okay. And the pre-retiree has always been a fixed income investor. And today he wants to come into the market. And therefore, I'm calling him as a beginner of, getting into markets. Now, when you have a low risk already, and that definitely comes from the risk profiling part, when you have a low risk, okay, and you say, okay, I want to have equity because that is how I'm going to beat inflation, because with fixed income, I will not be able to beat inflation beyond a point. But in equity also, there is a large cap, there is a mid cap, there is a small cap, there is a micro cap. So when we look at a pre-retiree, low risk, but wanting to have an equity exposure, he will definitely move towards the large cap allocation. And the minute you move towards the large cap allocation, and when you start comparing, you might realize is that the passives are doing far better than the actives. Actives may not do better. That's exactly what even Anil mentioned. And therefore, look at exactly a stage where a pre-retiree, a beginner with a low risk, realize the importance of having equity because to beat inflation. Now he says where I should go. He should move in for something like a passive allocation. I will just tweak the case a little bit. We are looking at a pre-retiree stage, but now a seasoned experience and an experienced investor is coming. So he has seen the markets. He understands market. Okay, share market mein khela hai. He has demat account. He has bought. Okay, he has tested the active funds, etc. Now, what do you think his allocation will be? Obviously, it will be little higher or overweight on equity. Correct? And that is where it is also a case to have a passive there because his portfolio or her portfolio is lopsided today. Because of experience, sheer experience and seasoning, obviously, either you are dabbling in the stocks or you are using a mutual fund, active mutual funds to use it. So the passive space is obviously missing. And in the large cap space, typically you will find that this is making a very, very strong case. And therefore, when you're looking at an active and a passive, both gels very well. Of course, there is no specific answer. It depends on your risk profiling. You do asset allocation. You look at equity. Equity can be 100% micro equity. Also, it can be 100% large cap also. So, you will have to really look at a case, look at the suitability, and then advise. But there is a perfect case to have a blend at this point of time is what we feel.
Thank you so much, Vivek. I think it was very well explained. And also for beginners who are starting early, have no nuances of the market, which is very risky, passives. And for them who have better understanding, active. Thank you so much. I think really, really well explained for all our audience. I'll bring in Koel out here. people have been talking about outperformance every point in time, but I think there are certain very basic stuff. There was a research which was done in American, and as per the American Research Agency, there was a report which speaks about determinant of portfolio performance. And you might have a good fund manager, good fund house, a good sector allocation. It is given that in that research, which was done for a period of 10 years by roughly 91 pension funds, which has been investing for a very long point in time, 91% of the return was due to the right asset allocation. And that's something which is what I'll try to bring in Koel here. How for a layman investor or early investors, it is important that, to have an asset allocation, right, in context of both optimizing active and passive investment strategies. And can you provide some guidance on effective asset allocation strategies here? Koel.
Thanks, Saket. I think it's very, very important. I think there's an age-old saying, and people keep hearing it again and again, that don't put all your eggs in one basket. That is actually, maybe an underlying to asset allocation, which basically is taking your investment portfolio and ensuring that you're putting it into different asset classes. Could be stocks, bonds, cash equivalents, whatever it is, and commodities, depending on where your preferences are and how your investment goals are aligned. Now, a key strategy that kind of drives asset allocation is you need to balance your risk and reward while diversifying between different categories. I think the more diversified you are, you're ensuring that you're not overcapitalized or overexposed into one segment, because what happens is as markets and economies, they are constantly changing. There are downturns. Stocks may experience very, very big declines, and at that point of time, maybe bonds and cash are doing well or commodities are doing well. So there is a certain balance where if one dips, the other kind of ensures that stability to your entire portfolio, right? And so this is where each asset class's risk return profile adds value to your overall portfolio balance. Now, if I have to, kind of list down what are the different asset allocation, it is quite a theoretical but, for the benefit of the audience and, for them to just understand the different kind of asset allocation strategies that are there, I'll just run through a few of them very quickly. But, there are permutation combinations that keep happening. There is something called as a strategic asset allocation, which is very similar to buy and hold. It's very simple. You buy your stuff and you hold it, ensures that you have enough diversification. So supposing there is a certain return that bonds are giving and certain returns that equities are giving, and you have a 50-50 percentage holding in each, you'll probably get an average of that. Then you have something which is constant weighting asset allocation, which is you constantly rebalancing your portfolio. If one dips a little bit, you're rebalancing it to create that maybe 70, 80, 60, 40, whatever balance you're doing within your asset allocation strategy. Then there is tactical asset allocation. In the long run, a strategic asset allocation seems relatively rigid. So, you then use tactical calls, small little shifts here and there, which moderately is very similar to active strategy, but you take those tactical calls. You have dynamic assets, where you are constantly mixing assets. And of course, then there is something called as insured asset, where you are kind of ensuring that your base portfolio doesn't go below a certain, level. If it does, then you're going into, risk-free assets. If it's higher, you keep maintaining a little bit of your active strategy. And then there are a whole lot of things. But one, strategy which I'm particularly fond of when it comes to active passive is core satellite. I mean, it falls into one of those categories, but core and satellite very similar to if you think about the sun and the planets. Very simplistically, your core becomes your sun and your planets are your satellite. Core basically defines what is driving your portfolio gains. So if you think that you're the kind of investor who likes to take active calls, has the time, is well informed, can keep track of the markets, active becomes a super core, and then you create a balance through the passive. I think Anil and both Vivek, shared how active and passive can have their own merits. I think that's what happens. And then, there are people who are not so sure of and don't have the, kind of ability to keep track of the markets. For me, for one, I do talk about financial markets, but I'm today at this webinar. I don't have the time to see whether the market movements are, kind of aligning to an active strategy. And preferably I am kind of a very passive advocate. So I like my passive to be my core. Maybe in my satellite, I will try to use tactical calls with using some active strategy. But that's the way I kind of work it around. And then again, I mean, coming back, it comes back to your investor's goal. What are his expectations? What are his risk tolerance? I believe that, Anil, as a manufacturer, also deals with an asset allocation on a very, very different perspective. And Vivek, when he talks to people, he has to analyze how he looks at each, kind of client's aspect and, outlook to what he's trying to achieve. So I think each of us have different ways that we look at asset allocation. So I think it is very important that to understand that one cannot time the market. So it is next to impossible. So it is important
Thank
that
you,
we
Koel.
take the correct advice.
Thank you, Koel. Thank you so much. Well said, Koel. Spread your eggs under different baskets. Clearly, that is the theme, and that what goes also for active and passive. Rather than just hinging or staying with one, it's better to spread your bets, and it really has a lot of reward attached to it. Now, coming to I think Vivek, Rege, the fact that you have been a part in all the investors who are looking forward to join the bandwagon of investing in passive, right? They have in mind, market is not a straight line, right? It has its up, down hiccups there, right? But eventually from 1,000 or 100 to 57,000, right? That's a journey it has reached. Are there any market condition which is favorable either for passive or for active? So the question is that can you discuss the role of market condition and economic cycle in influencing the performance of active and passive investing? And how should investor adapt to the changing market dynamics? Are there any specific sector, asset class where active manager tends to excel? Or, for that matter, even a passive excels in that area? Can I get Vivek for this? Vivek?
Yeah, sure, Saket. Am I audible?
Yeah, very clear. Please.
Yeah. Okay. Yeah, so a great question, Saket. So the way I look at it is, and I had mentioned also earlier, that a lot depends on the typically the information asymmetry in the market. Okay, and the market conditions, are such that at various points of time, when we look at the market, it might leave us confused. So I think the better way to look at this entire thing is that take a zoom out view. Okay, and at a zoom out view, I think the question to ask is that when you look at something like a passive, passive space per se, I think the question to ask is that at certain points of time, the passive space does very well. Now, this is exactly a time when, hello?
Yeah, go
am
ahead.
I audible?
Yeah, you're audible, Vivek. Go ahead. Vivek, go ahead.
Okay, so at times you will find that the passive space is doing extremely well and the active fund managers are really concerned. So the market sometimes get polarized in a way where there could be uncertainty. So the way I look at it is that when let's say there is a political uncertainty, okay, and if there is a political uncertainty, there is a policy uncertainty what we look at. Now at exactly that point of time, it becomes very difficult for an active fund manager to really make a sense of it because there are too many moving parts at a point of time.
Very true.
And because of this, you might find it very interesting that the passives do very well versus the active at that point of time. Okay, the minute there is a bit of what should I say? There is a bit of betterment of the investment climate where there is predictability in which way the policies are going. The active people or the active managers take bets on those active sectors, and therefore active management does pretty well. So one has, as an investor, the simplistic thing is to look at how is the overall investment climate per se. Is it confusing? Is it too much of confusion, too much of chaos happening? Okay, too many moving parts, it becomes very difficult for an active fund manager to perform. If there is a bit of a stability and there is a direction to the policy, then the active fund manager can really perform well. So I think that is something which is very important. So the investors may want to look at that. Also, over a period of time, the information asymmetry keeps coming down, and therefore the space of the passives will continue to do well. And let me give you a very important data point, and this is a bit dated data point. This was given by Morningstar Direct in October of 21. Okay. So there are essentially that point of time, there were 14,650 global equity indices. 14,650 global equity indices. If you look at the broad-based indices, out of 14,650, 11,559 were broad-based market indices.
Okay.
And sector indices were only 1,171. So
Interesting.
that answers the question that, you know, the sector indices will have a limitation, number one. And therefore, you will see a lot of companies giving broad-based indices, number one. Number two, the developed markets and the emerging market, if you look at a ratio, out of 14,650, 8,415 were developed market global equity indices. And emerging markets were only 2,210. Okay, the balance was a blend, which is a developed and emerging market, which is another 4,006. But
Right.
guess what? In that 4,006, you will find more of developed markets because that's how things work. You will not have a higher
Right.
weightage on emerging markets. So what is this number telling us in October 21? This number is telling us is that some kind of a wave has happened in developed markets where the active fund managers were finding it difficult to beat the passives. And therefore, people started asking the question, hey, if you cannot beat the active and if you cannot justify your fees, let us move to passive. And therefore, if you look at the global data, you will find 14,650. Developed market has about 8,415. That constitutes about 72% of the global indices. We are just at the tip of the iceberg where India has started getting into that, and which has started in the large cap space, and that is quite evident from the SPIVA report also. And therefore, in my view, I think investor should understand the market structure and the information asymmetry for sure, but definitely have this blend in the portfolio because this is the way the future will be. Okay, over a period of time, as it comes down 1 decade, 2 decades, 3 decades, maybe your strategy might shift. But it is at this point of time, it is an inflection point where you really need to be open with trying different ways. Yeah.
Thank you, Vivek. That's interesting data, which itself speaks for its, for the advocacy of the combination of both the strategies, right? I'd like to bring in Anil here. Anil, whenever you make investment, there's certain parameters you keep in mind, and passive is a new animal in the room, right? One would like to know what are those, right? It's very important for our layman investors to understand what should he keep in mind when investing in a passive, right? Active, obviously, favor of understanding has come in, right? So the question to you is, what are the key performance benchmarks and metrics that investors should use to evaluate the success of their hybrid strategy, which is both active and passive? Are there any success stories, though this is very early, but are there any success stories who have effectively combined both these strategies to achieve their financial goal? Anil? I think before we move, Anil, I think would like to see the graph which you have shared. Can the graph be shown?
Yeah, sure. I had pushed it on that thing, but I'll just...
Right. You have already shared. Yeah, here it is. Right. Anil, please.
So what I was trying to say here is that structurally, if we see this part, let's say 10-year time horizon, not even focusing on the short period, and if you look at this number, this is the worst performer, this is the best performer. Now, with the benefit of hindsight, if you were unfortunate that, let's say, this red colored fund, when you selected it 10 years back, that time, let's say it was the best performer and had a star manager running it. But over the period, it became one of the underperformer. Then that's a big gap that you are going to lose over here, basically, Rather than that, one other alternative is that just simple allocation to index could have been better. That is what the point I was trying to say.
That's a beautiful illustration, Anil. I think it is clear-cut reflection that you don't want to be the best, don't want to be the worst. Just be on an average, which is best of both the world. Thank you. Thank you so much. Can we come to the question?
Yeah. See, I think little bit, to be very honest, I got confused with the complexity of the question that can there be a benchmark to measure investors' return where the investor, she or he has invested some amount into active, some into passive, and whether we can measure the success. being a market practitioner, being a manufacturer, running both active funds for so many years, focused on passive funds and all that. So I'm supposed to be so-called expert. I'm also finding it confusing. Investor will be completely lost if we try to showcase them benchmarks to measure their performance. Now, what I'm trying to highlight, why I'm trying to, it's a wonderful question. Sorry, don't get me wrong. I'm just saying it's a wonderful question. But I'm saying let us look at our investor. Let us look at the way in which today Vivek connects with his clients. Vivek is like a family advisor to each and every of his client. Since you gave me the permission to share screen, I got tempted. Now I'll share one more screen.
Okay.
Let us look at this particular person. This is again a particular thing. I just coined the thing that there is this one gentleman, Mr. X, and he's a dentist. मुझे पता नहीं एक्चुअली डेंटिस्ट है, बट ऐसी स्माइलिंग फोटो था, चार जन स्माइलिंग है, तो आई सेड ओके डेंटिस्ट. नाउ what is the dentist's requirement when he comes to Vivek or any of the friends who are in the advisory fraternity? That okay, I am running my life comfortably, happily. My key aspects are, let's say, for example, something to take care of my business requirement. In the next, let's say, 3 years or in the next X years, I want to buy a little bit bigger clinic, or maybe I want to focus. After 10 years, my daughter wants to go to US for studies, or my son has some XYZ thing. I want to allocate some money for that, or structurally for both of them long term, I want to have a comfortable retirement. This is my monthly income. Sir, आप बता दीजिए Vivek sir what I should do. Now, in that, the focus should be not on how the performance of the allocation is working, or whether the star manager has been selected, which will increase the returns by a few basis points, or when active is underperforming, when passive is doing well. So I believe for such kind of thing, there is a very nice quote. It's a very interesting book on behavioral aspects, behavioral finance, that investing should not be about beating the market, but about achieving your goals with reasonable level of certainty. So if we come back to the thing about how the measurement of a strategy where we have invested some into active or some into passive, I would say, as long as you have set your life goals, aligned some financial plan with it, with the consultants and guidance of a family doctor, family advisor like Vivek, and does some good mix of little active and little passive, that is a measure of your success. Then the outcome of the return profile, in certain periods, some active manager had been able to outperform, or they are underperforming, and for this period it was better. Koel madam is very much a proponent of a report called as SPIVA in her erstwhile role with S&P. SPIVA report comes out every 6 months. This many number of outperformance by active funds versus index. The SPIVA full form is S&P, which was the company who does it, and SPI, VA, the index versus active. But that is for people like you and me, Saket, or for Koel and Vivek, and people who are sitting in our rooms with our fancy, Bloomberg screens or our tools and calculators. Not for the Mr. X, who is the dentist. He is focusing on a different tool which will give you the best treatment, and he has to focus on enhancing that skill set. Not कि भाई 1 season 6 months जब विवेक सर को मिलना है तो बोले कि साहब आप बैठो, आपको समझाता हूँ, ये मेरे स्टार मैनेजर ने ये सेक्टर में ओवरवेट किया, ये सेक्टर में अंडरवेट था, बाजार में ये हो रहा है, इकोनॉमी से. अरे बॉस, मुझे क्या करना है उससे? मैं तो फोकस हूँ कि मेरे डेंटिस्ट्री में नया लेटेस्ट टूल क्या है साहब, नेक्स्ट टाइम आपको दांत में कुछ पीने तो टेंशन मत लेना, आप आना मेरे पास, राइट? सो दैट इज हाउ वी नीड टू realign our thing and create the measures of success in the way that, okay, you did a good mix, like everybody we spoke, that get the best of both worlds, use the power of and, combine both the two, and that's the measure of your success.
Thank you, Anil. I think so simply put in, very nice. Just one thing I would like to ask from you. In the interest of the participant you shared, there's a lovely behavioral book, right? Can you just name the book for interest of the participant?
Certainly. So that book is called The Aspirational Investor.
By whom?
Very simple book. Again, like people who are financial market experts, we all say कि हाँ, हमने सब बचपन में बेन ग्राहम की बुक पढ़ी थी, गोल्डन कलर की, everybody will have it, The Intelligent Investor. ठीक है बॉस, बट मैं डेंटिस्ट हूँ, मुझे इंटेलिजेंट इन्वेस्टर बनना ही नहीं, मुझे आता भी नहीं है, मैं क्या समझूंगा उसमें? तो फॉर दिस काइंड ऑफ audience, there is a very simplistic book. It is called The Aspirational Investor, and it is fit into my mind because we had hosted the author of this book, gentleman Dr. Ashwin Chabra. He's US based. He was the CIO at Merrill Lynch Wealth Managers or Investment Manager. I forgot where, many years back. That time we were part of the joint venture with Merrill, so I recall broadly. So, and he had authored this book many years ago, but certain things of that book are so simplistic. I mean, not as much as like a, okay, God like a Benjamin Graham, no doubt, but for a practical person, for an understanding, for a practitioner of wealth management or something, it's a very interesting way to put things, you know.
Thank you, Anil. Thank you so much. The fact that, we started passive little late. I think 2001 is where India tasted its first, passive funds, especially gold bees, right? To name yesterday, I think Vishal Jain was there in one of our webinar and he shared his entire detail. Globally, things have been much better. It's been, I think, 30 years, right? Last February, the global market has completed 30 years of the passive investing. I would like to bring in Koel here that, what are the learnings? Has there been any case where the global market has combined both active and passive? Is there any learning which we have where there is something which Indian investors can learn? And has it really helped them or there is any thing which they have been able to experience really well? So the question is, how is the global market shaped up in using both strategies, and any key learning there for Indian investors? What are the prospect of passives now, we believe, as we progress in India? Go ahead.
Yeah, Saket. So global markets are different. I think at least in my previous avatar, with S&P and seeing the global markets, currently I think numbers are around $10 trillion with over 11,000 products that are there in the market right now there. Of course, markets there have been promoted by 401k, which is the retirement plan. Here in India, if you have to draw parallelism, EPFO has kind of driven growth for ETFs in India. There is tax efficiency that also promotes ETFs globally, which is then again something which we can aspire to and be that aspirant investor in the ETF space. I think one of the things which we are learning and one of the things which are very clear for India is India has actually skyrocketed in terms of growth. If the global markets have taken something 2 decades to grow, India has kind of jumped in and got there faster. So I think we have a lot of learnings where the US markets or the European markets or generally global markets are already ahead of the game, and we are kind of picking that up, be it moving from just general market return ETFs to now moving to smart beta products or factor-based products. So I think that's the kind of learning that we are gaining. ESG is another space which is really growing out in the global space. It's getting introduced into India slowly and steadily, and I think it's gaining pace. But you also have products like electric vehicles that have made their kind of entrance into the markets. So from a Indian perspective, I think the passive market is a growing today. That's almost 17% of the entire mutual fund industry. So it's kind of growing, definitely growing at a very high pace. And I like I said, people like Anil and Vivek are also propagating the inclusion of such passive kind of investments into the portfolios of investors. As long as that keeps growing, and as long as investors get this kind of education from platforms such as ETF Pathshaala and other platforms which are sharing more and more knowledge, I think that's one of the gaps that desperately is needed in India to ensure that people understand what passive offers, and that it is actually, if somebody wants to sample the equity markets and get basic equity returns rather than jumping into equities, direct equities, passive is a good way to start.
Thank you, Koel. Coming to Vivek, thank you so much for the insight. And I think the participants we have here would love to have Vivek as an advisor, but very difficult for each of them to reach there. It would be good if they can get some insight how you really manage the wealth of investors. So the point is that there's so many help and support you get as far as active is concerned, because it's obviously MFDs and others help. But here in passive, the support mechanism is missing. Can you just help them how can they negotiate this entire curve of taking that information? So the question to you, Vivek, is that how can investors stay informed and make well-informed decision as they navigate the dynamics of investing world? As you know that the investing world is very, very dynamic in nature, and especially when it comes to choosing between active and passive. Vivek.
Yeah. So see, I would like to approach this question in a slightly different way. So for example, when you look from an investor point of view, typically, I think most of the investors forget to answer this question is in terms of knowing themselves well, which is expectation setting. Sometimes the expectation settings are not done and they are looking at the market to set the expectations. The expectation setting should start with them, and then the market suitability and what part of the market you want to get into is a function of the expectation setting, which happens internally and not externally. So I think one of the things which I've seen consistently, and with 2 decades of experience, I can tell you that for sure, is that investors come with an external market expectation, okay, without their own understanding of what the expectation should be. And I like what Anil mentioned, right? This is where you try to understand what are your goals, right? And by goals, so if you really look from a point of view of a aircraft and a runway, okay, there are goals which basically are going to be 200 kilometers from now, and I have to descend. I have to descend my altitude over a period of time because I have to land on that particular runway. Okay, if my goal is 1,000 kilometers away, I can fly at a 40,000 feet above sea level. So the point is, if your goal is short term, which is going to be 200 kilometers away from now, and you are going to fly at a 40,000 feet, you're definitely going to miss something. Okay, you're not able to kind of land that. So giving you a very, very simple example is, one is expectation setting. How do you set it? You start with your risk profile. Please understand what you are. You may not be an aggressive investor. You may not be a passive investor. You are not the same person who is sitting besides you. So important is to get your risk profiling done. From that, you will know that as an investor, what is your financial DNA? What am I? How much can I tolerate? Once I understand that, I will start looking at allocating my equity, debt, cash, and gold. And within that, I will then choose whether I should use an active strategy or a passive strategy. Okay. And the third approach, which is often not spoken about, is an outcome approach, which means that, hey, look, I'm not interested too much in active or passive, but I need a certain outcome. Can my investment deliver me a certain outcome? I think that is very, very critical. So the best way to look at it is that first, if you can figure out your goals, okay, so there is a milestone. There is a market which is external, which will be continuously changing and it will always confuse you. So, but once your goal has been defined, then you start asking the right question in terms of suitability. And in suitability, then you ask a question whether I want to go active, I want to beat the market, or I want to go passive, which I want to make a market rate of return. Do you want to take a risk of an active fund? If you don't want to take a risk, first simply go with a passive fund, because you don't have the time, you don't have the luxury to kind of get into more specialized advice. Simply stay put on a passive at that point of time. That will be the best way to kind of de-risk yourself. Okay, so I think to answer your question, and I think I have kind of attempted to put that in a kind of a small framework, is that one, you start with your expectation, do your risk profiling, try to ask your goals, that what kind of assets do we need to complete it, and then marry it properly. And then you choose a style, whether it is active or passive, and that will help you to start making a sense of this entire, navigating the dynamic world, because the world will continue to be dynamic. Correct? We cannot help it. We need to be firm about it. The world is going to be dynamic. So let me kind of put this very, very important thing to the audience as well.
Thank you, Vivek. I think very clearly you mentioned that before we start looking at anything, it's first start with yourself. What is your expectation, your risk appetite, and then proceed further. Generally as we speak, going to a party, neighbor has made 20%, the colleague has made 30%, and that gets heads in, which is not the right way to look at, investing. It has to be. So thank you so much for, I think, explaining that point so well. We'll just take a question from the participant. I'm quite enamored with the questions which has come up. We will have to take 2-3 questions definitely, despite the paucity of time. The first question is that I heard that just go for passive or ETF to avoid any hassles. How do I select which ETF to go for, and where do I see that? Who would like to take this among the panelists?
If I say, then people will say, Anil, आपका खुद का ETF है तो bias बोलते हैं. So I will request either Koel or Vivek to please share.
Very true, Anil. Yeah. So
otherwise, I have a very clear answer that there is a link on my webpage where we can list all the ETFs and index funds of DSP, but I don't want to say that.
Anyway,
and I believe the financial advisor is the best person to give a neutral view.
Vivek,
yeah, sure. So, so I think if you are entering into the passive world, start with a simple passive fund, which is essentially a kind of a large cap index. Look at the Nifty 50 index. Start with it. Okay, once you kind of gain confidence of investing in that, then you expand it to, let's say, next 50, which is the next 50 companies. Okay, so slowly, steadily, what happens is that you start getting a hang of what does the passive investing really means. Okay, and when you are seeing a line item in your own investment report, you start tracking it more. Okay, I believe is that line item, seeing that line item is very important. Okay, so typically when you are looking at a passive fund, you look at an expense ratio. Okay, today a lot of media publications are giving this information very easily. Okay, a passive fund which is having a low expense ratio, okay, having a low tracking error is something you should go with. If the brand is something which you align with, just go for it. Have the line item, tracking is better. Slowly start getting into slightly broader indices. So for example, you start with the Nifty 50, settle that down. Then you go to next 50, settle that down. So that is a way, you can go. Once you cross the first 100, then you are getting into a mid cap space. Okay, there is an index for everything, provided your investment portfolio requires that. So the best way is to start with a simple Nifty 50. Look at a low expense ratio, look at a low tracking error. That would be my advice to start with.
So I'll just add one more thing. Sorry, I was that time even joking side, but we have made a very nice simple presentation. One slide only, how to select a passive fund. And it was a joke. I will not be, of course, talking about DSP. So this is like a kind of a pointer, like 6 point we highlight basically. Structurally, first and foremost, I think as Vivek mentioned, just you need to select your expected risk and return, align that with your investment concept. That time you do whatever research, etc., what you want. Then, yes, you focus on certain fundamental aspects like what is a tracking error, what is a tracking difference. But I like the way Vivek said, get a comfort on the fund house, broadly speaking, then just go for it. Because structurally, your risk and return outcome, whether it is fund house A or fund house B, will be very much broadly similar in line. So look at other aspects like ease of transaction, branch access. In today's world, you don't need much of access to branch and all. You look at how the digital platform is. Do they have a nice user interface, UI, UX, and the mobile app? But still, if there is a branch close by, you feel a little bit better comfort. It's like saying you have a flexibility to open your salary account with any bank. But hey, by the way, next to my home, there is a XYZ bank has opened an ATM. Now, ATM today, how many people will want to go? Or, you can use any bank's ATM. But still, नहीं boss, हाँ, मेरी बैंक है, उसका logo दिखता है, ATM दिखता है, मुझे comfort है, I will open my salary account in this bank only. I have an option to open anywhere. Everybody will give me very similar facility features, one checkbook, one ATM card, one credit card, one RM, one flexibility to do this, 4 movie tickets in a quarter, whatever might be, broadly similar. So, with these aspects, but certain concept-wise. So, for example, one point I've captured over here, whether that particular fund house do they have a dedicated investment desk? What kind of ongoing servicing and reporting requirement they will meet for you. Some of these things are very small, but they can help in a big way. That is that fund house having a focused effort on passives as a category? Is the fund house friendly in terms of their servicing to me as a client? If I need anything, basically, जरूरत नहीं पड़ती तो जरूरत ही नहीं पड़ी, साल तक जाओगे नहीं आप fund house पे, doesn't matter. But one off, suppose in the month of June, July, like you have gone to your CA and she or he is saying, मैडम और सर ये तो आपको लेके आना पड़ेगा फॉर्म कुछ समथिंग 26 AS के बोले 26 BS कुछ निकला नया, जाओ अपने फंड हाउस से कुछ मांगते रहो. and you log into your mobile app, not able to get it, okay, reach out to somebody, and if they are able to service, that is the wow factor. Rest all will be similar. Risk and return of that fund will be very much similar. So I think these are the small aspects which can help little bit. And otherwise, for all the selection of fund house and all, I to always say you are the dentist, you are Mr. X, focusing on the best of quality for your life and your family. Just go to a trusted financial advisor like Vivek, wherever he is suggesting, just park your money, don't worry.
Thank you, Anil. I think you really answered. There was a question for you. In fact, the question goes, for Mr. Ghelani, you have been a very lucid in your conversation. Can you tell a layman how can one person select some funds, active or passive? How do I know what's good formula for me? I think you answered already. I know to in part or whatever.
Sure,
so
thank you.
we'll leave it here. I'll take just two more questions. Thank you so much, participants, for really adding so many questions. Really interesting. So the one question is that, do I need an advisor for an investment? How do I know I am in the right hand? Anyone who would like to attempt this from the panelists?
Well, everybody has a view, but in my view, like I feel definitely yes, you need an advisor. I mean, Vivek will hesitate to say that because, like how in the first question I was hesitant, so I will say it on his behalf maybe, and then maybe you can add something, Vivek, if I'm going out of track. But see, structurally, like I said, today, not even for just that Mr. X who is a dentist, even for me as Anil Ghelani, as a market practitioner, I don't have, frankly speaking, track of my personal allocations or when to do what or allocate. Basically, there is a one close friendly colleague since many years. He's a financial advisor, so I rely on his little bit judgment. Some overlay on that, I do it myself. Frankly, I'm not saying no, but core by and large, he keeps track, keeps follow up. I have a once in a 6 months. He'll come near to the office care and even just niche on chai pite or discuss broadly. Once in a 6-8 months, he comes to visit my home, meets with my mother also. Like she has her own independent way of allocating and thinking. So he comes and connects there also. I feel very strongly that today, little bit if you're unwell, certain basic medicines, or you can go to Google and search and take it. No doubt, that's good enough. But still, you want कि नहीं बॉस, मैं एक जन को मिलके आ गया, वो देख लिया, भले ऐसा हाथ रख के भी देख लिया कि नहीं सब कोई बात नहीं, थोड़ा ये ले गया, परफेक्ट मेडिसिन है, सो जाओ अभी 2 दिन में आप ठीक हो, वो सुनने के बाद ही मुझे नींद आएगा. Like that, if one goes to Dr. Vivek and Dr. Vivek has said ki, yes, don't worry, you are in a proper situation. This is your good mix of passive and active. Don't worry, I'm giving you the right mix. Relax and go back to your job and your work or your business. Then that person will get a comfort, basically. So certainly there is a need for good sound advice.
Completely agree, Anil. I think that is what it is. Even a good doctor, right? They don't do their own surgery or look at a car. You don't prepare car at home, right? Clearly, the space list will help. And this is for all the audience here. They are only going to help and, improvise on what you intend to do.
Yeah, no, and Saket, I think we'll add here, and if Vivek can elaborate on that, because I think I heard, I concur with Anil. A lot of people who are in the financial space don't take financial advisors. But Vivek, I think one aspect you can, maybe elaborate. I know we are very short of time, but I really like to know from a financial advisor's perspective as well, because it's just not active and passive, right? You look at it holistically in terms of all their assets. I think that aspect, if you can, just help and say that it's just not one aspect of just where you're putting your savings in, but holistically looking at, financial advice.
Correct.
Yeah, correct. So I think one of the points which I want to mention is that, see, basically an advisor would tell you pretty much the same things. But what difference does they make with an advisor? And I think your question is that how do I know, I'm in the right hands? I think essentially, if you see your advisor behavior, managing your behaviors, okay? Because managing a behavior and managing an investment are two different things. Okay, managing investment is very transactional. Okay, hey, look, this is Nifty 50 put in here, low tracking error, low. This is transactional, technical. Itna investor ko samajh mein aaya pata nahi. But the minute you understand that this guy is understanding me, this is me, he's understanding me, he has understood my burning issues, he understands how I behave, and now he's giving me advice. Okay, and therefore we often say is that we don't manage wealth, we manage behaviors.
So well said. Yeah, that is very, very true. Very, very true. Thank you. Thank you, Vivek. I'll just take the last question. I'm very enamored with the responses. The question goes, which fund will be the best for economic downturn, right? Is it active or passive? Who would like to take this question? Which one is better for economic downturn? Anil?
See, I think structurally, sometimes in economic downturn, you could still see capital markets not going down. So maybe if the question is slightly, I'll rephrase it, that when markets are in a correction along with economic being slow or down. So in that situation, I feel sometimes it is better to be with a passive fund. Reason for that, and I'll show it with the example, is that in the March 2020 crisis, we saw sharp correction in broader markets. Everything was falling. Both active fund will also fall, passive fund also will fall. Now, in the passive fund, there is no human bias. Means my funds were running fully deployed position, 99.5, 99.75% invested. When 27th March happened, and let's say Nifty 50 started turning and started moving upward, reaction on the ground was still doomsday scenario. Vaccine has not yet been decided upon. On ground, everything is on standstill. People are still thinking कि सब कुछ खराब होने वाला है. Markets are going to continue downward trend. There is a huge time yet, by the way, before the central banks and central governments stimulus will start working. Because mind you, that time everybody's previous crisis experience was very short. It was 2008-9 GFC, global financial crisis, which was very different. So human mind and human bias was thinking differently. But from 27th March, when we started seeing the sharp rally upward in the market, many passive funds were fully aligned with the index, and they started seeing returns exactly in line with that particular underlying formula, whether Nifty or Nifty equal weight or Nifty next 50 or whatever might be the underlying index. But many active funds were still very hesitant. अरे क्या बोल रहे हैं? तो खाली ऐसी dead cat bounce है. That was the terminology. If many people are familiar, के economic situation is not yet improved. Economy is still very slow and sluggish. But little bit there is a small spurt in the capital market side. So they were still underinvested. They were still invested in very defensive stocks. After another 2-3 months, they started catch up. But by that time, there was a very sharp rally which had already come. Now, for these kind of situations, I'm not saying that that fund manager, she or he took a wrong call. It was the right decision, but it is the way your human mind is wired. That time, everybody was, because in your real life also, you were facing that, कि boss घर से बाहर निकलने का नहीं है, ये नहीं हो रहा है, वो नहीं हो रहा है, तो boss, who will go to the factory and who will run the company and who will analyze the growth of the company? So that human bias tends to sometimes work negatively. Hence, in this kind of example, what I have seen that being invested in a passive fund can little bit help in a better way. Even downside, like sometimes, like in this same period, like we had couple of active funds, couple of passive funds. Within passive or within a particular range of funds, like there is a one particular index called Nifty equal weight. So that acts like a buffer, because certain very large names, which are high beta names, which are tend to correcting faster, they are cushioning that particular downside. So if you cushion the downside a little bit, then in the upside, you get a better push in terms of your growth. So I feel that no doubt there is no single right answer. One can argue other way also, that when the market is falling, maybe the active managers are fast to take a cash call and sit on, let's say 5, 7, 10%, depending on the mandate, what is approved. They can take cash calls to protect the downside. That is also a very good answer. But sometimes I feel that the human bias can, like we said in the beginning, it's a coin toss. Heads aayega, tails aayega. You can either go wrong, either go right. So if you go wrong and you miss that particular upcycle, then you can have a little bit of a challenging time to then play catch up again. Hence, in this situation, I feel passive fund will be better. Basically.
Thanks, Anil, for putting this in perspective, especially taking that example of what happened during COVID, which I think clearly clarifies the answers to that. Gentlemen, we have come to the end of the session. A heartfelt thank to each of the panelists, right, for sharing their wealth of knowledge. I think to start with Anil, he gave a good understanding, especially explaining things with graphs so vividly and clearly. Vivek sharing his insight, and Koel for his wisdom of being in passive for so many years, right? Really, it made very engaging, very a good learning experience for all our participants. As we conclude, remember that in dynamic world of investing, it's not about choosing one or other. It's about creating a symphony of strategies that resonates with your financial goal, where you imbibe both of the best world, right? So thank you so much. Thanks a
I think
lot.
I'll take just 1 second more, Saket, that
Yeah, Anil, yeah.
you forgot to mention very important aspect. I would like to take it up because you will feel hesitant. In my view, what we have just come in today, done a very small part. What you guys are doing at ETF Junction is very good. You are not just creating a platform, but ensuring that a good mix of people can come and share knowledge on your portal. Lot of insights, lot of information is also available. So a large variety of people, whether it's investors, whether it's advisors, whether it's manufacturers, everybody can be a part of that ecosystem, and it is already, and in times to come, I'm sure it will help even much more to the end users and end investors. So I would like to thank you, Koel, everybody at ETF Junction team for working on these kind of initiatives and making a robust platform for this particular part of the market. Thank you.
Thank you, Anil, for this wonderful words on us, on the efforts which we and our team is making. This is a reflection of the entire ETF Junction team who's put this show, and we have been really encouraged with those words of yours and the entire industry's feedback. We'll continue taking this initiative forward. Thank you so much. Thanks a lot.
Thank you very much.
Thank you.
Thank
you,
you very much.
everyone. Thanks, Anil.
Thank you, everyone. Bye.